presides over its constitutionality. That's according to Politico. The House votes next month to approve a package by GOP leaders to fine lawmakers for shooting video or taking photos on the chamber floor. The move is said to be a response to last June, when Democrats used cell phones to live stream a 25-hour protest after Ryan's refusal to allow a gun control vote. And new census figures show the three northernmost states in New England continue to see stagnant or declining populations. Experts predict that will limit economic growth in the region. That's according to the AP, which says challenges are slightly different among the states, with Vermont losing population, Maine growing but seeing more deaths than births, and New Hampshire growing at a much smaller rate than in preceding years. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Live from Bloomberg's World Headquarters in New York, I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick. We are 30 minutes away from the close of trading here in the U.S.
Indeed, and U.S. stocks are falling the most in 2 weeks in light holiday trading. Financials, energy, materials weighing on the S&P 500. The Dow's quest for the 20,000 mark is faltering.
But the question is, what'd you miss?
Stocks may be taking a breather today, but the big moves are in currencies and crude. The dollar touching its strongest level in more than a decade, and WTI rising for an 8th straight day, its longest winning streak in nearly 7 years. Disney's Rogue One has propelled it to a record-crushing year, and a slew of highly anticipated films may push the studio to an even bigger haul in 2017. Bloomberg's analyst has the outlook for media in the coming year. And Toshiba's U.S. nuclear ambitions turn into a nightmare. The company saying it may have to write down billions related to an acquisition by its U.S. unit. Yet another stumble in the rebirth of the nuclear power industry.
All right, let's look at where the major averages stand now. As we head towards the close, Bloomberg's Abigail Doolittle is standing by. Abigail?
Hi there, Oliver. Well, we are certainly looking at declines for the U.S. major averages heading into the close. We have the Dow, S&P 500, and NASDAQ all trading lower. In fact, near the lows, the Dow is shedding 100 points, more than 100 points at this point, putting Dow 20,000 and new record highs out of mind. In fact, this is the second worst sell-off for U.S. stocks since the election, a bit of a pause in the Trump trader rally. Taking a look at this on an intraday basis, when we look at an intraday chart of the S&P 500, we see that the index actually opened slightly higher, but then we've just been steadily lower as the day has been progressing. At this point, 96% of the members in the S&P 500 are trading lower, only 23 higher. So it's a pretty broad-based sell-off. And in fact, all 11 sectors are lower as well. Interestingly, the S&P 500 right now is actually at its lowest level since December 8th. So a bit of a round trip from the rally that we've seen this month. As for a round trip on the day, we're looking at natural gas. We have a great chart here, an intraday chart of natural gas. And look at this spike higher. Natural gas had been lower and now up by about 5%. It had been up earlier, 6%, after dropping 2.5% earlier. So lots of volatility in this marketplace. This on a report that the Arctic chill could cause stockpiles to decline to levels last seen in 2013 or even before that. So natural gas getting a nice bid. And on the year, natural gas is up in a huge way, right now up about 68%. As for some other asset classes, when we take a look at the Bloomberg Dollar Index, the yen, and the 10-year yield, we're seeing a little bit of a haven bid here. This matches the sell-off that we're seeing in stocks. We do have the Bloomberg Dollar Index up, but well off the highs earlier. The Bloomberg Dollar Index had been up 0.3%. The yen is trading higher. That's that haven bid that we're seeing, a bit of a reversal from earlier. And then the 10-year yield also down 5 basis points, represented in green. This tells us that investors are buying stocks or buying bonds as they're selling stocks, and that is probably hurting the dollar index. Of course, rising rates tend to boost the buck, and now we're seeing a little bit of reversal, so the dollar is off of its highs. As for what could be ahead for the 10-year yield, when we hop into the Bloomberg and take a look at a great chart from Bloomberg intelligence analyst, strategist Vincent Signorella, this is #BTV 2256, and in blue we have the 10-year yield. In white we have the 5-year inflation swap. This is basically a very forward look at inflation expectations. And Vincent Signorella says the swaps lead, that typically the 10-year yield goes up through the swaps and then dips back down. We see this in several instances. prices. Right now, we do have those swaps declining, suggesting that the 10-year yield could just follow lower, reversing this quarter's big move up in yield and perhaps taking the Bloomberg Dollar Index off of its record highs as well. We could see a bit of a reversal in the new year.
Very interesting. Thanks so much, Abigail.
What do you miss? Since Election Day, Donald Trump and Wall Street have enjoyed a bromance, with U.S. stocks surging in celebration of the president-elect's business-friendly agenda. But how long will the love last? Let's get some insight into the year ahead with Quincy Crosby, market strategist at Prudential Financial. Quincy, thank you very much for joining us. Obviously, there's been a huge flip in the way people think about the Trump administration and the stock market since the election. Basically, since that night he was elected, and there was that snapback of the futures, and people are coming up with all kinds of reasons why Trump is good for the market. Is he going to deliver in 2017, or will it be a disappointment?
No, I think there'll be disappointments, but I think that he knows what the agenda is supposed to be. And it's interesting that the market, after going crazy at the thought that he could win, if you remember, peso went down, gold went up,
right.
Basically zeroed in on just a few key things, and that is pro-growth, lower taxes, reflation, and is focused on that. And chances are he's going to deliver on the tax cuts, of rollbacks to some degree, or maybe fine-tuning of regulation, for example, in financial services, just to give you an example, energy. And he just has to deliver on some of them. It's going to take a while before they're actually assimilated by the economy. But as you know, the market looks ahead.
Right.
And the market's been looking. If you look at the financials, and that's one of the most important sectors, this wasn't, oh, my goodness, Trump won. It was the 10-year yield moving higher, the 10-year yield suggestive of a stronger economy, but also something that the financials badly needed. And once they got that, the financials took off. So you could say that's a byproduct of Trump, coupled with perhaps a rollback of maybe a little bit of the Volcker, maybe a little bit here or there. No one's expecting an expunging carte blanche of any of these regulations, but just a bit of fine-tuning.
When you look at sort of what has happened in terms of strategists, it's very interesting. I don't think I've ever seen a year in which so many people's targets for next year is contingent on something. A lot of it is related to tax cuts. Are we thinking about markets improperly when we say, okay, here's our view for the market next year, but it's if this certain tax cut happens or this corporate tax level goes to a new level?
Well, the fact is that when we look at the projections for next year, they're actually some of the lowest that we have seen in many, many, many years in terms of where the market is going to end. I think the consensus is that we may move up maybe 4.5%. That's not very much. And as you know, Oliver, every time you go into an earnings season, what do you see happening?
Generally, markets go up.
Yeah, and why? Because the estimates come down, 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 and it's very easy to beat those. But also, when you go into an earnings season, there are a lot of shorts in the market. So all you need are some positive surprises. The shorts get covered, and the market moves higher. This time around, actually, the strategists have been fairly conservative. There are very few who have said we're going to see 7% return or 8%. It's been the consensus is 4.5%. So I think, look, strategists have a job to do, and they go through the year changing those estimates along the way. Above all else, you have to see the economy improve. If you can see the underpinning for the stock market improve, which is the economy, you should see corporate earnings move higher. Today, you see the dollar pulling back a little bit. You know, there's always something in the market that is a beneficiary. So the multinationals are probably a beneficiary of that. Emerging markets are probably a beneficiary of that today. But as we go through, I mean, there are headwinds, but there are plenty of tailwinds. And above all else, what the market is expecting, and I hate to use this term as an economist, PhD, the animal spirits, the return of animal spirits, the ability for companies to say, you know what, we can do this and we can do that. There's been, for the last number of years since the recession, it's been almost, fear. Just be careful, just be careful, just be careful. And that's why we're looking at consumer confidence, but also small business confidence, CEO confidence. It has to be enacted, has to be implemented, materialized. But the market is betting that to a large degree, we're going to see some of it.
And yet, since the election, Quincy, yes, we've seen stocks go up, we've seen risk assets go up, but Oliver and I have talked about this theme frequently. There's also been a higher level of dispersion. So you've seen some markets, some sectors, I should say, disproportionately lead the gains. So going into 2017, are you safe just buying stocks, buying the S&P 500 and forgetting it? Or do you have to really be more careful about where you're putting your money?
It's difficult to say this because we've been wrong for a couple of years. But it looks as if active management may actually work in 2017 versus passive investment. Doesn't mean we don't care for passive investments, but it looks as though perhaps you want to be very, very stock selective.
Something we've been talking about a lot on this show is sentiment. And where are we in the sentiment cycle? And is there room to go higher given the growing bullishness of strategists and investors and consumers and everything? Are we at the euphoria stage, or do you still sense a reservoir of skepticism out there about this market?
Yeah, there's still a reservoir of skepticism because we could see how much money goes into the market. I mean, if you compare today to the tech boom, which was reach parabolic stages, that fear of missing out. No one is in that camp right now. Perhaps, during the season in which we see window dressing, the hedge funds, institutional money managers, mutual fund managers, tweaking their returns. But the retail investor is still skeptical that this was brewed by cheap money by the Federal Reserve, central banks, and now Donald Trump. But there's one thing that always seems to work. Money goes to where it is best treated. And if the stock market is that vessel for returns, I think you're going to see more money coming in.
So the relative return case, again, for stocks.
The relative return case, but make no mistake about it, the pension funds are rebalancing, and many think one of the reasons today the bond market is doing well versus the equity market is the rebalancing goes on now. But those pension funds will go into allocations that are doing poorly. They'll probably be putting money into emerging markets. They'll put money into emerging market bonds. All the areas that right now we're saying the stronger dollar may hurt those, they will be putting money in those groups.
All right, Quincy Crosby, Prudential Financial Market Strategist. Thank you so much.
Thank you so much.
Coming up, we'll hear from another strategist, Tobias Levkovich. He's the chief U.S. equity strategist at Citigroup, and he's going to talk about his S&P 500 outlook for next year. This is Bloomberg.
What you missed, Citigroup raised its S&P 500 forecast for 2017, citing the possibility that President-elect Donald Trump's economic agenda will boost corporate earnings. Tobias Lefkowitz, chief U.S. strategy for the company, joined Bloomberg TV last week to talk about the new target.
So let's start with the numbers. So we're looking for $131 next year now for the S&P 500 earnings, up from $120.50 this year. Of that kind of 9% increase, if you run the math, you're getting about 3 percentage points coming from the energy sector, looking stronger this year versus a year ago, given higher oil prices, and that translates into better numbers for the producers of oil and gas. In terms of the tax cut benefit, in other words, the stimulus program, we're just looking at a 20% tax rate, down from about a 27% effective tax rate for the S&P 500 currently. And that would add, exceptionally important here, only the fourth quarter. So we're assuming this is a fourth quarter 17 phenomenon, another couple percentage points. So if you kind of then look at the package, you're only looking for kind of another 4% or so coming from the rest of the market, which is pretty modest. For the following year, we actually introduced a preliminary number for 2018. We're at $146, and about $9 of that improvement comes from the Trump tax cuts. Now, we're not assuming anything about a stronger economy. We're not assuming anything about capital spending really getting potentially a boost from 100% depreciation write-offs. There are going to be offsets. We're going to find out a lot more details next year on this, but just simply on the lower tax rate, you get that bump to earnings, and as a result, you get some bump, and we don't think you get quite the same bump to the market as you do on the earnings front. In other words, we don't value tax-related earnings the same way we would value an improvement in kind of underlying operational leverage, because quite honestly, you could have a future administration take away that tax cut.
Right. It could be temporary, at least in theory. When you talk about valuing these earnings, I have a chart on the Bloomberg, which I can describe to you. I'm not sure if you can see it, that looks at the forward price-to-earnings ratio of the S&P 500. We're up around 19 right now. This is a 5-year chart, so it shows that we're more than one standard deviation away from the 5-year average of the forward PE. And, of course, we've had this run since the election. So in your mind, where is sort of fair value at this point, given that outlook for earnings and given the run that we've seen and given that we're above sort of the near-term historical norms there?
So there are probably about 3 problems with the question, to be fair. First one is, even if I have valuation metrics, and we do, that notion of fair value, my opinion of fair value, doesn't really matter when you have millions of investors determining where they think that fair value is. So I think people who slap on their own PE expected level are somewhat arrogant that everyone's going to listen to them. Number 2, and more importantly, the 5-year time frame that you're talking about also, if you put up the price to yield on the 10-year Treasury, you'd also see a fabulously crazy multiple on them, and nobody ever talks about bond markets being overvalued. In fact, if you go and look at a 20-30-year history and compare the two, we've had massive divergence between the two, where bonds look crazily overvalued relative to stocks, and stocks didn't get any of that benefit in the last 5 years. So I think the 5-year history kind of distorts the kind of real, if you want to call it, perspective. Sorry, my earpiece keeps coming out. And the third piece is, when we do think about valuation, we do this on a normalized earnings basis, but we also do it on a normalized bond yield basis. And then on that basis, we have an 87% probability that markets will be higher in the next 12 months, looking back over 45 years of history.
Tobias, before your earpiece falls out, you graded yourself B plus for 2016. Not quite an A. Where did you fall short? And let's spin it forward also to 2017 on a sector basis. What's going to give you the A grade in 2017?
First of all, Mark, I'll tell you, I didn't get that many A's in school because I didn't apply myself that hard, and I'm a kind of tough grader on myself. But the 2 areas that we think we missed this year were, one, the extent to which the rally would occur, but I'm not sure many people would have really assumed kind of an 8% move since the election. So we had a target of 2150. We're closer to 2250 for this year, and that's part of the grade hurt. The second piece was that small caps have really run hard here again since the election, where most of the outperformance are tied tied to a stronger dollar, which we hadn't anticipated. So those are the two failures, if you want to call it, in our calls. I think we got a number of other things right. In terms of the coming year, I suspect the continuation of outperformance in financials and energy. I think there's a fair amount of pushback that these may have run too far, and we think there's an opportunity there for it to go further, given that we don't believe, and again, we may be wrong, but we don't believe that investors have fully embraced those views.
Tobias, can you just explain to me, something Julie and I have been battling each other over in the last couple of days is lack of volatility. But when you look at futures, VIX futures, VSTOXX futures, you see a gap between now and 3 or 4 months, a large gap, a multi-year gap. Does that tell us we're storing up a bout of volatility in months to come?
So one of our themes for 2017 is a return to volatility. Well, I think most people focus on some of the political issues, which I'll come back to in a moment. We actually look at the shape of the yield curve, and it's historically been about a 2-year lead indicator for volatility, and it is indicating a pickup in 2017 into 2018. With regards to the kind of political dynamics, I think people are going to be focused on a new administration, going to Congress, different bills that they want to pass. You know, what's the ease at which they're passing those bills? There's going to be, I suspect, some political backdrop to things like repeal and replace Obamacare. There are going to be issues around what the tax cuts look like, what are the offsets, removing state and local tax deductions from personal tax rates, or some sort of border tax issue that's being discussed in Congress. There's going to be a lot of fighting around that. It's not going to be like beautiful, smooth sailing.
That was Tobias Lefkovich, Chief U.S. Equity Strategist at Citigroup.
And it's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Malaysia's state-owned oil company Petronas wants to move ahead on a proposed $27 billion natural gas project in Western Canada. That's according to people familiar with negotiations. They say a new site for shipping the gas has been identified that reduces costs and circumvents an environmentally sensitive marine area that has been the flashpoint of controversy. A decision on the project is expected early next year. British online retailer Boohoo.com was a gold mine for retail investors, with the stock soaring about 260% for the year. That's the biggest share rise of any Western European consumer-related company, with a market cap of more than $500 million in a year packed with retail underperformers. Boohoo clothing and prices are targeted at 16 to 24-year-olds. Its speed of design model is much like Zara's, only much faster. And Kate Spade is working with an investment bank to explore a sale of the company. That's according to Dow Jones, which cited people familiar with the matter. The high-end handbag retailer has contacted possible buyers, including other retailers, after coming under pressure from activist investors. The company is not commenting. And that is your Business Flash update. Boohoo.com.
Never heard of it. Up next, we're taking a look at some charts shedding light on the housing markets, the Treasury's plans, and the relationship between stock and inflation predictions. This is Bloomberg.
I'm Julie Hyman. What'd you miss? We had the pending home sales number for November out this morning. It was down 2.5%. Analysts and economists have been looking for a gain of 0.5%. But the folks over at Bloomberg Intelligence, the economists there say don't get too concerned about the housing market. Why? Well, if you look at pending home sales in blue here, you see this decline that we saw over the past couple of months. However, the white line is mortgage applications. So far, they've risen 5.8% in December after a 2.4% gain in November. That, the BI economists say, is room for optimism before year's end that we could still see an increase in those pending home sales.
Plus, if rates are rising because the economy is doing good, then maybe it could be another tailwind for the housing market. Here's something people aren't talking about much, but that we'll be talking about in 2017. The debt ceiling. It used to be a big crisis every once in a while. Now, not much of a concern, but it's still out there. Here's a look at how much cash the Treasury is holding at any given moment. And as you can see, the debt ceiling will be reinstated back in March. It's temporarily suspended. And the Treasury is going to draw down its cash on hand all the way down from $1935 billion, over nearly $2 trillion, to $23 billion in the months ahead as part of a cash conservation measure. So keep an eye on this. We'll see if it's smoother for Trump than it was for Obama.
Debt ceiling, throwback. I like it. We haven't heard about that, but we're going to. All right, one last thing here for me. I'm looking at basically expectations for what's going to happen next year in terms of two things: inflation and stock prices, because right now the two are moving pretty dramatically. You look basically since November, our latest reading we had this week, consumer confidence in the stock market is shooting up to the highest it's been in years. At the same time, inflation expectations also shooting up, guys. So the question is, are people under the impression that the two could go up together? There are a lot of people that say they can, but obviously we'll find out.
We'll see.
Market close is next. Quick check on the major averages with less than 4 minutes. Got a little bit of red on the screen, as we know, closing down today. This is Bloomberg.
Moments away from the closing bell. What'd you miss? Stocks retreating. The Dow's quest for 20,000 taking a breather. All 11 S&P 500 sectors are in the red. Financials, materials, energy leading those declines. And the Nasdaq falling the most in nearly a month. Meanwhile, treasuries are rising after a 5-year auction drawing strong demand. And WTI is on an 8-day winning streak, its best in nearly 7 years. I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick.
We want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
And we begin with our market minutes as we see stocks fall today.
Yeah, not a great day. We opened the morning thinking about Dow 20K, and guess what? It didn't happen. In fact, we went the opposite direction.
Another day,
and no Dow. But here's what did happen. We did see some interesting moves, nonetheless, just in the opposite direction is where we started. Basically, I want to start with some sectors. Real estate and financials in particular were bringing the S&P 500 down. Real estate actually was the biggest loser on the day. Well, I guess financials ended up about 1% lower. Real estate also 0.9% lower, so not great news after we basically had some housing numbers today for pending home sales that were a little bit worse than expected. Then if we take it over and we look at some of the individual companies here, there were some interesting movers. This is the market where all these interesting moves happen now, right? NVIDIA down quite a bit, about 7%. Chesapeake Energy down over 4%, with energy names not doing well despite oil flat on the day. Best Buy had some news. There was some chatter on Twitter, but I don't know if it ever came out why it actually dropped. It's down over 2%. On the flip side, Coach jumped. Kate Spade obviously up about 20% on takeover rumors. And then quickly, I'm going to jump into the sector volume on my Bloomberg because one, it looks awesome. Two, you can see where there was a little bit of activity today because there was some activity. Infotech, here's that big chunk NVIDIA right there. You can see that it was trading about 270% above its average. Then you want to check out what happened in the energy space over here. Chesapeake trading way above average. So
well, and it's funny, NVIDIA was on your wheel of volume yesterday as well. Yep. It was higher yesterday. It's the best performer in the S&P 500 this year. Right. And yesterday as well was trading on heavy volume.
It was down on Andrew Leff from Citron saying it's not worth quite as much, more like $90 to him.
Right.
Let's look at government bonds because there was a fair amount of action there, particularly at the long end where we saw the 10-year yield drop by 0.05. One of the bigger drops in yields for the 10-year since the election, fairly significant move. Interestingly, the short end was higher, so definitely some significant flattening today. Keep an eye on that. It's been a while since the 10-year yield has made new highs. It's actually back to levels that we last saw the day of the Fed meeting, so about 2 weeks ago exactly today. So keep an eye on that.
I guess that explains your financials move down.
Exactly right.
Yeah, and Quincy Crosby from Prudential a few moments ago suggesting maybe it's sort of end-of-year pension fund positioning, potentially contributing to some of that reversal. Let's take a look at currencies, shall we? The dollar falling versus the Japanese yen, 117.20 there, the trade. However, the euro and the pound each weaker versus the U.S. dollar. So the dollar not showing uniform weakness. In fact, if you look at the dollar index, the DXY, it is now trading at its lowest, going all the way back to 2002. Not the Bloomberg dollar index in this case, because it was conceived in 2005. That's when it begins. But the DXY, so you can see there, trading near its highest since 2002, as we have continued to see this pretty consistent run in the dollar.
And on commodities, let's wrap up. Not a ton of action anywhere. Actually, basically nothing anywhere. We just skipped this part. No, gold up a little bit. Oil hardly changed. And the one loser I saw today, but it's pretty marginal. Copper down 0.4. But basically no action in commodities.
There was a little bit of activity in oil for a bit. It was up and then it came back down.
And then it ended flat,
at the end of the day.
Yes, and it still had a winning streak, even though it sort of squeaked it out there. Those are today's market minutes.
Joining us now to share his insight on today's market moves and more is Bob Cinch. He's global strategist at Amherst Pierpont. Bob, I want to start by checking out oil. So even though, Joe's dissing oil today, there's, I guess, some interesting moves that you've been looking at. I want to dive into the terminal real quick because we've got a chart here basically showing some of the technical levels we've been looking at. We had this bottom back in January and February, closer to about $25. Now we're more than twice at that, $54 on crude. When you look at the gains, there's obviously quite a bit of a rally here this year, but over the past 6 months, it's basically flat. So what do we look at when we're at this level here?
Joe may regret these words today. We'll see. But, I think today could have been a very important day. If you look back in early in the year, January, February, we had a double bottom. And oil tends to want a double bottom and then potentially double top. So technically, you know, we had a high early in the month of 54, 51, I believe, was the high in early December. If I saw correctly, we got as high as 54.37 today. I'll call that close enough to a potential double top. So it could be very interesting that going into year-end, just as the OPEC supply cuts are set to begin, that we might be putting in a double top here in oil. So this could turn out to be a very important day. If you get convincingly through 54, 51, I think that's meaningful. You're going higher. We may look back a month from now and say, you know what, we had a double top on December 28th at 54, roughly 54.50, and oil's come down since then. The other thing pushing in that direction, inventories for this time of year are still at a record high, higher than they were last year. And the rig count is starting to not only pick up, but in the last 3 weeks, the Baker Hughes rig count has actually been accelerating to the upside. Now, we're still, you know, less than half of where we were at the peak, but, you know, U.S. suppliers are beginning to pick up activity. So this could end up being a pretty important week for oil.
If oil does top here and sells off, what are the sort of knock-on effects of that? Of course, one of the big winners this year, high yield benefiting from the rebound in energy. Oil tends to have movements in oil tend to have impacts on inflation outlooks in the market. So let's say we do sell off. Where do we want to look for the damage?
Well, I think what will be the most interesting for me about this is whether this signals that OPEC's no longer really, in a big picture sense, the big swing producer, right? Because if OPEC agrees on cuts and non-OPEC members agree on cuts, and yet U.S. production picks up and the oil price rolls over a little bit, I think that's going to be very meaningful from a big picture perspective. Obviously, in the shorter term, the biggest beneficiary actually may be the bond market, which we're talking about today. You know, the bond market quietly has retraced over half. The 10-year yield has retraced over half of the sell-off that took place on Fed Day. So 242 before the 2.42% yield before the Fed announcement, up to 264. So halfway back is 253. We're under that today. So if we do get some retracement in oil, one of the beneficiaries could be the long end of the bond market. And maybe that's a little bit of that flattening that we started, that you referred to earlier, happening today.
What about any knock-on effects on the U.S. dollars? I was just talking about the DXY holding near its highest since about 2002. What happens with the relationship between those two going into 2017? You
know, if oil comes off, and we're starting with an assumption, but if oil does come off and yields continue to come back down a little bit, that may put in a bit of a top here for the dollar, because as we've looked at it, the dollar really has been driven by interest rate differentials. The correlation has been about as tight as it's ever been. And certainly earlier today, it was suggesting a pretty good rebound in the dollar, which we got. But if we hold these lower yield levels, I think that could signal we're getting a little bit of a top here in the dollar. And it's, you know, they're all correlated. It's not clear what's driving which. I think the key driver here is probably oil prices.
Okay, so how do we assess oil? I mean, we've got this technical stuff going on, but from the fundamental basis, I see a lot of different forces here that are playing on it now. We've got stronger dollar expected. We've got OPEC cuts that are expected. We've now got a very energy-friendly Trump administration. Who knows what that's going to do for supply in the U.S.? So how do you even go about assessing it from a fundamental standpoint right now? Which one of those is the most important?
Well, you see, that's where I think we could be at a major turning point, and who knows, a couple of months from now, maybe the president-elect will tell us that we can thank him for lower oil prices also. But look, if OPEC's cutting supply, and the cuts are only going into effect next week, right, the beginning of January, if prices still come down, even as they begin to implement those cuts, and we continue to see U.S. production activity picking up, I just think that has enormous ramifications. You know, it sounds silly, but for the next decade or more. Sure. Because what we're saying is that it isn't OPEC that can swing production. It isn't Saudi Arabian production cuts that can swing prices. It's really the U.S., and the U.S. has taken on a much more important role in the global energy markets than we have for probably the last 30 years.
Now, you mentioned the rig counts are starting to creep back up. We've also seen employment in the energy industry in the U.S. start to creep back up after falling for month after month after month after month for so long.
And orders for equipment also starting to creep back up.
Right, so we're seeing these sort of positive signs there. Does that mean you invest in the energy industry in the U.S. going into 2017?
Well, you know, I think that a lot of this still reflects excess supply. So, you know, I think it's difficult for me to see the oil price really moving significantly higher. If we're seeing global shifts in who's producing, I'm sure there'll be some winners and some losers. But I think in general, you know, we're in a commodity now where I think, particularly if the administration looks more favorably on the coal industry and what that can be, you know, what role that can play in the energy mix. That you could be, you know, in a period where energy is well supplied and probably not a great place to be invested.
We talked to Boone Pickens on this show not long after Rex Tillerson's name was put out there for Secretary of State. And one point that he made, making the case that U.S. supply won't come back, is that labor markets are really tight. A lot of people who had been working in the oil patch gone on to construction already, found different jobs. How do you think about the labor aspect of that? And in general, labor market tightness, how big of a story will that be for 2017, given, you know, expectations of more infrastructure spending and lots of different areas of the economy needing workers?
Yeah, I mean, I think there are selected sectors. You know, Steve Stanley, my colleague, talks about this a lot. There are selected sectors where there are some supply shortages of labor. And certainly in the construction area, the energy area could be one of those where there could be some supply constraints. But don't forget, we came from a rig count that I think was in the U.S. was at over 1,400, and it's now back to about 650 or something like that. So you would think there are some rigs that can be operated pretty efficiently that can be brought online pretty quickly. Look, if we're going to have another surge in production in the U.S. like we had in the last 10 years, yeah, I think that's a problem. But once a lot of these wells are dug and basically are operational, I think they can be brought back online without the same degree of labor.
Bob, great conversation. Let's keep it going. Bob Cinch, global strategist at Amherst Pierpont, stays with us. And up next, we'll assess what data from Japan to Italy and here in the U.S. is really telling us about the state of the global economy. This is Bloomberg.
I'm Taylor Riggs. Let's get to the first word news this afternoon. Secretary of State John Kerry has outlined a plan for resolving the Israeli-Palestinian conflict. Kerry's speech comes after the U.S. angered the Israeli government at the UN last week by refusing to veto a resolution censuring Israel for West Bank settlements.
The two-state solution is the only way to achieve a just and lasting peace between Israelis and Palestinians. It is the only way to ensure Israel's future as a Jewish and democratic state, living in peace and security with its neighbors.
Israeli Prime Minister Benjamin Netanyahu denounced the policy speech, saying it was skewed against Israel and obsessively focuses on Israeli settlements. Netanyahu underscored his backing of the incoming U.S. administration. In a tweet, he thanked President-elect Donald Trump for his, quote, warm friendship and clear-cut support for Israel. And in a pair of morning tweets, President-elect Donald Trump blasted U.S. policy towards Israel. He tweeted, quote, we cannot continue to let Israel be treated with such total disdain and disrespect. They used to have a great friend in the U.S., but not anymore. The beginning of the end was the horrible Iran deal, and now this. He was referring to last week's UN vote. Trump continued saying, stay strong, Israel, January 20th is fast approaching. Meanwhile, U.S. Senator John McCain says the country's relationship with Latvia will not change with the new Trump administration in January. McCain spoke in Riga after meeting with the Latvian president.
We will continue to have strong support for NATO in the Congress of the United States and in the United States Senate. We believe, the three of us and most of our colleagues in the United States Senate, that Vladimir Putin and Russian behavior is unacceptable. The latest being apparent attempts on the part of the Russians to affect the outcome of the recent election in the United States.
McCain's visit comes as part of a wider tour of Russia's Baltic neighbors amid worries the U.S. may not be fully committed to the defense of its NATO allies following statements by U.S. President-elect Donald Trump. The next stop will be Lithuania, and after the Baltics, Ukraine, Georgia, and Montenegro. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
What'd you miss? A slew of data out overnight and this morning giving investors an update on just how some of the biggest global economies are faring. In Japan, industrial output, rose the most in 5 months in November as export volumes rebounded sharply. In Italy, consumer sentiment rose to the highest in a year. And here in the U.S., fewer Americans signed contracts to buy homes in November. So what is this global picture, as disparate as it is, telling us? Still with us is Bob Cinch, a global strategist at Amherst Pierpont Securities. Let's start in Japan, shall we? Because you're actually looking at the picture there as relatively positive.
Yeah, I think there was I think probably what's behind a lot of this was a big global inventory liquidation. We saw it in the U.S. I think it was global. And, of course, when inventories are coming down, you're going to see weakness in production. So you saw a lot of weakness in industrial production during the first half of the year. You saw it in the U.S. You saw it in China. You saw it in Japan. We've now seen over the last 4 or 5 months that particularly purchasing managers' indexes for the manufacturing sectors, in fact, have all picked back up, into the 52, 53, 55 range, which suggests that there is a rebound taking place. We've seen that in the PMI readings in the manufacturing sector out of Japan, and we've now seen it confirmed in some of the actual data. So I think, when you look around the world, we have had this bit of an inventory swing. Things are now picking back up a little bit. Looks like growth is firming into the latter part of the year. And I think that was a significant part of the bond sell-off, was the realization that, in fact, the global economy was maybe gaining a little momentum.
Yeah, you literally just took my next question right out of my mouth, because so much of this bond sell-off, people were talking about Trump and reflation and fiscal stimulus. And it seems like there could have been some of that. I mean, there was a pretty sharp move right after November 8th. But I'm curious, if people, I mean, now I don't even really need to ask the question, but how much really was the result of what people sort of being more aware of what's going on in the world economy?
You know, one of the relationships I do look at in terms of yield levels is a global economic surprise index.
Yeah.
So you take the average of the global economic surprise indexes for developed markets and emerging markets, and that over time tends to correlate reasonably well with 10-year Treasury yields. And there was a big rise in economic surprise indexes to the top side during the latter part of the third into the fourth quarter. And the rally in bond yields is pretty consistent with that. So my view has been that a lot of the sell-off in bonds and rise in bond yields was a function of actual economic data, the continued increase in oil prices and its potential spillover effect on inflation, and really had very little to do with expectations about what's going to happen to policy as we go through next year.
All right, let's talk about global economies and the impact on currencies. I want to jump into the chart real quick just to sort of address some of the topics that I know you discussed last time we were here. The dollar strengthened a little bit past where you thought, but we're still within this range here. I'm looking at the euro dollar and I'm looking at the dollar yen. White line euro dollar, basically last time we were here you said, all right, this is about a 105. I can see that going. We can see we've run a little bit past that. The yen on the flip side, we're at 117. You're saying about 115, maybe this thing starts to top out. Is this just about the dollar strength just powering through every currency, or is there an ability from some of these economies to push back due to their own economic growth?
You know, I think a lot of this was and you're right, I did think dollar yen 110, 115, euro dollar would stop around 105. A lot of these were broken on the Fed announcement, and I think the Fed was a bit more aggressive than we expected, I think than most people expected. That has pushed U.S. interest rates a bit higher than I think was expected before year end, and that's taken the dollar with it. But I think we're now in that same environment. If yields continue to come back a little bit here, I think we'll go back and see those levels, 105, 115.
Yeah, if we go into my Bloomberg real quickly, I just want to go back to your point about surprise indices. I don't have these averaged, but a while ago I made this chart. All the big ones, Japan, U.S., UK, Eurozone, China, EM, and what's striking is every one of them is above zero right now. If we zoom in, we can see this very rare situation. They're all above that red line. Yeah. Going back out, that almost never happens. These are mean reverting indices just by their nature because they're not objective. They're versus how people think. As they inevitably swing the other way, which they will, you would expect that would cause yields
bring some yields back down again. Yes, and don't forget, markets react to changes in expectations. Right? And the economic surprise index is a classic measure of changing expectations. As you said, it is economic reports that are coming out either better or worse than the consensus expectations. And in that context, that's where I think it holds information value. And as you said, it's been a lot of surprises to the top side.
Yeah.
All right, Bob, thanks so much for coming in. Bob Sinch is global strategist at Amherst Pierpont.
Coming up, it's been a roller coaster year for crude, hitting a 12-year low and soaring to a 17-month high. I'll have the chart that tells the story in today's deep dive. This is Bloomberg.
I'm Julie Hyman. What'd you miss? Let's take a deep dive into the Bloomberg, and you can find all the following charts using the functions at the bottom of the screen. And speaking of something that you probably missed, this is municipal debt on the Carrignandi Water Authority. Now, Carrignandi is not a household name.
Who missed this? Isn't everyone watching the Water Authority bonds all day?
I know you might be, Joe. I actually would not be shocked if Joe Weisenthal was watching this, but this has to do with Flint, Michigan, and the spreads that we're looking at here, the yield to worst spread on these bonds to the B-Val Muni A-rated revenue 5-year curve for these bonds maturing in 2033. We've actually seen a tightening. Okay, so what does all of this mean? This essentially means that even though we've seen new criminal charges in this Flint water crisis recently that stem from this debt, the bondholders don't appear to be concerned. We've seen the spreads tighten since this has been happening rather than widen out. So just an interesting disconnect here between the headlines and the investment and what we're seeing.
Kind of reminds me of Venezuela, how the bonds had a really good year, even though it's just negative headline. And markets are surprising sometimes. Yeah. Speaking of surprising, let's talk about oil. We were just talking about oil with Bob Singe. But let's put in perspective what a crazy year it was for oil. Going back to January and February, oil was falling out of the bed. It was down near $25 a barrel at one point in February. It just seemed like this was the total end. Then it rebounded. Then in June, there was a failed attempt by OPEC to get a deal. That was also, it had re-entered a bull market. Then in August, it re-entered a bear market. And then it re-entered a bull market very fast. These huge 20% swings. Then in September, that sort of preliminary deal where they started talking about they might get a deal. And then, of course, earlier in December when OPEC said not only did it have a deal, but it got the details. It's just, I mean, this is extraordinary to remember what a crazy year it was, thinking about what we were talking about in January and February and how much a year can surprise you in how it ends up.
It's a good time to be long oil volatility. There's an ETF for that, right? There's an ETF for everything.
Probably.
All right, real quickly, I'm going to look at what's happening in the industrial space within the stock market because it seems like everybody just thinks, all right, this new Trump era, industrials are doing well. But guess what? It's very specific where they're doing well. The Y line here is the industrial index overall up 7.5% since November. But guess what? It's really in a few areas. Here's trading companies and distributors. I'm going GICS 4 on this because I know Joe likes GICS 4. And construction and engineering up here, up 20%. That's really where the gains are coming from. It is very much the places that sort of rent out materials and space. I think that's going to be interesting to see if they can maintain those gains despite the rest of the index. Zip codes. There you go, as Tom Lee would say. All right, up next, look ahead to the outlook for media stocks in 2017, according to our very own Bloomberg intelligence analysts. Here's a look at some media winners this year. Viacom down a lot. This is Bloomberg.
I'm Taylor Riggs. Let's get to the first word news this afternoon. Dylan Roof has told a judge he plans on calling no witnesses and will present no evidence to try to convince a jury to spare his life for killing 9 black Charleston church worshipers. Roof told a U.S. district judge at a hearing he still plans to act as his own lawyer when the penalty phase of his trial begins next Tuesday. Saudi Arabia received a notice that Oman intends to join its anti-terror coalition. That's according to a person familiar with the matter. It's a sign that Iran's closest ally in the region is ready to improve its relations with the kingdom. Oman's ties with Saudi Arabia and its allies in the Gulf have been strained because of its close relationship with Iran. And on Capitol Hill, House Speaker Paul Ryan's crackdown on live streaming on the House floor is raising questions from experts on both sides over its constitutionality. That's according to Politico. The House votes next month to approve a package by GOP leaders to fine lawmakers for shooting video or taking photos on the chamber floor. The move is said to be a response to last June when Democrats used cell phones to live stream a 25-hour protest after Ryan's refusal to allow a gun control vote. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Thanks so much, Taylor. And now let's get a quick recap of today's market action. We saw a sell-off in stocks, some interesting reversals today of the post-election move. So stocks moving downward, but we saw yields on the longer end of the curve going upward.
Significantly low.
Yeah, lower. Sorry, shorter end of the curve.
Everything's flipping today.
Yeah, so it's kind of a strange reversal. The NASDAQ and the S&P in particular selling off, each down about 0.8%.
And another day on Dow 20,000 watch. Yeah. What'd you miss? Over the past few weeks, we've been looking at industries and what to keep your eye on for the upcoming year. Today, we'll focus on the outlook for media and advertising. And here to help guide us is Bloomberg analyst Geeta Ranganathan in our Princeton Bureau. Geeta, thank you very much for joining us. A lot of anxiety out there in media land, pretty much wherever you look, TV, print. Everyone's worried that Facebook and Google are swallowing the whole thing. Is there a light at the end of the tunnel for media? What's it going to look like in 2017?
Yeah, so as you pointed out, Joe, I mean, there's going to obviously be a very significant slowdown in ad spending, which is the building block of most of the media subsectors. We're not going to have the benefit of some of the marquee events that we had in 2016 with the Olympics, with the election cycle. We're not going to have that heading into 2017. And then another factor that is causing a lot of nervousness amongst a lot of the investors is, of course, Brexit, which happened in June. And then more recently, Donald Trump's victory. And that is really expected to cause some near-term pullback from advertisers, which is causing a lot of, at least, trepidation in the short term. Now, with Brexit, we really didn't see any substantial evidence of pullback, but I think it's safe to say that the general tone, at least in advertising, is one of a fair amount of caution.
At the same time, Geeta, we've been talking a lot about consumer confidence that has been improving the metrics from the past month or so since the election. We've seen a lot of optimism about tax cuts and the effects on corporate America as well. Are these factors that are poised to potentially help ad spending and help some of these media companies as well?
Yeah, I think so. I definitely think it will, longer term, I think so. Also, another big thing that most media investors are looking to, and with a lot of relief, is a potential deregulation that is expected to definitely help the cable industry, for one, which has really been subject to a lot of onerous regulations from net neutrality, from open competition for set-top box and whatnot. And also, mergers and regulations, a much more favorable outlook for the merger scenario amongst different content owners as well as distributors.
Well, Geeta, so, all right, let's back it up 1 second here, because it feels like everywhere else in markets, it's a very risk-on, it's a very, get pumped up about this year and go out and spend money on the economy. But it seems like in the media landscape, they have the opposite. The Trump transition is having the opposite effect, where people are more hesitant. So why is that? Is that he's going to crack because his comments on AT&T, or what is it exactly?
I mean, so I guess that there are two different, views here. for the ad spending in general, and this is really general ad spending, we're looking at a little bit of nervousness and a very cautious outlook from both the forecasters as well as the big ad agency networks. But then if you look at the cable companies, for instance, the pay TV operators, the Comcast, the Charters, we're really looking at a much more favorable climate, especially as a lot of these companies have really been burdened by a very, very stiff regulatory environment. And with the FCC kind of in transition right now, I think they will benefit a lot from a much more pro-business, more business-friendly climate.
And I guess they won't have Trump's debate ratings anymore either to piggyback off of.
What about people have been talking about cord cutting and the skinny bundle and alternate ways of getting people to pay for media in a modern 2017 world. When you look at the various skinny bundle endeavors out there, are there any that really seem to be taking hold and getting traction?
Yeah, I mean, as you point out, the whole media landscape has really been shaken by this whole cord-cutting thesis. There's been a proliferation of, streaming services, what we call virtual MVPDs, the most recent one being, AT&T's DirecTV now, which really seems like a very compelling offer. It's $35 for 60 channels. So I think that one is going to do pretty well. I think the general consensus is that it's going to do pretty well. And there are really a lot more services that are out there on the horizon. Possibly one from, YouTube, from Amazon, Apple, definitely Hulu coming out with one in the early part of 2017. I think the general consensus, though, is that the pay TV ecosystem is not going to be as badly hurt as investors had feared. I think the general consensus is that as more of these services come out there, it's actually good for the content owners because more people consume linear TV content. So the risk of subscriber losses and the affiliate revenues might be mitigated.
Geetha, we've been talking a lot about TV. Let's talk about the movies. We've been talking about Rogue One and its big box office that it's done so far. Every year feels like the year of the blockbuster, right? Is 2017 going to be the next year of the blockbuster?
I mean, it's been incredible. So when we started out with 2016, there were actually we had a lot of hiccups as we went through the summer season because we saw a very weak start. But it's actually recovered really well. We're actually headed for a new record in 2016, some $11.3 billion in domestic grosses ahead of 2015. And if you're looking at the slate for next year, it looks equally impressive. So I think we're headed for another record in 2017. Of course, Disney there keeping up a lot of the momentum.
All right, Geetha, wrap it all up for us here as we look into 2017. Within the media sector, any companies, any sectors that you guys think are going to particularly be newsworthy that you're keeping your eye on over at BI?
So I think one of the big themes that we are tracking in BI is definitely this whole convergence topic and the entry of cable into the wireless space. I think that's been a big announcement that's come out of both Comcast and Charter. It looks like it's the next big thing for the companies in the cable landscape, and I think it's also been partly precipitated by AT&T's acquisition of Time Warner and those two key watchwords there, mobile and video. So that's something that I think we're definitely going to keep our eyes out for. All
right, Geetha Ranganathan of Bloomberg Intelligence joining us in Princeton. Thank you very much.
And coming up, we'll hear from Julian Emanuel. He's Executive Director of U.S. Equity Strategy at UBS. He'll tell us why he's cautious about the market rally. This is Bloomberg.
What'd you miss? UBS's head of U.S. equity and derivative strategy, Julian Emanuel, has one of the lower S&P 500 targets for 2017. Not that low, at 2,300. He explained why on Bloomberg Daybreak last week.
This bull market has climbed an absolutely unprecedented wall of worry, and I'd say even disgust on the part of investors, whether it is uncertainty about earnings growth, which we haven't had for 2 years and we are about to have once again, whether it's, the implications of an oil price crash on the economy, or let's face it, incredible divisiveness within the political sphere in the U.S. Perversely, in the logic of financial markets, the last 6 weeks have really taken down that wall of worry and replaced it with a really, really deep sense of optimism, almost euphoria, as it will, that we think in the medium term is perhaps reflected in prices.
Reflected in prices, okay, so that's why you're at the lower end of the targets on the street for 2017. When do you think that catches up with the rest of Wall Street, the euphoria that sits around this table and says, you know what, I believe that we're going to get those good things. Just yesterday, we caught up with Steve Orth of Federated Investors, who said, you know what, it's not a wall of worry, it's a wall of hope, and we're due for a pullback. Take a listen.
We're due for a pullback, Jonathan.
Yeah.
Right? I mean, we've had a straight move up. Yeah. The question is, how deep of a pullback? I think in a wall of hope environment, the pullbacks are likely to be shallower and shorter. So for sure, we're not all in ourselves on equities here, but we are advising our investors to buy the dips as opposed to sell the rallies now.
Buy the dips. Let's get tactical. Is that going to be the story through 17?
It's been the story for the last several years. We continue to think that that's going to be the story in 17. However, where I would differ is you look, we're at VIX at 11 right now or so, and that is signals a sense of complacency. And again, it could well be that the hope that's built up over the last 6 weeks does get materialized over the course of 2017. But the fact is at 19.2 times 2016 earnings and an implied growth rate of 12.4% in earnings next year, a lot of it is in the price. And where we would differ, again, is that we think that the volatility episodes are actually likely to be sharp on the order of what we saw prior to the election and prior to the UK referendum.
So it's one thing to have this narrow spread on the bullish calls. It's also unanimous. Nobody is descending at this point. And I wonder at what point do we get nervous just because of unanimity? I mean, we're well into this cycle. We're well into this run. Maybe it's not over yet, the bull run, but at some point it's going to have to end. Does it make you a little nervous just on that ground alone?
We would prefer being contrarians. Make no mistake about that. And again, this surge of optimism is something that, strangely, in the logic of markets, does have us concerned. Where we would be even more concerned is actually if you got, a surge of optimism, a wall of money come into the markets, and then the legislative agenda starts grinding as opposed to moving quickly, because it really is about what can get accomplished next year.
Goodness knows that's never happened in Washington, that the legislative process grinds slowly or more slowly than we thought. I mean, if that's really what we're betting on, is it moving fast?
We're changing D.C., David. Catch up.
Well, I just wonder if we're really expecting Donald Trump to defy gravity. I mean, he may accomplish a lot of good things, but what we're expecting him is a tall order.
We are, and if you look at it, the other side of that argument is by the logic of past situations where Republicans have dominated both the executive and legislative branches. They've been able to deliver in terms of equity market returns. But this one is a little bit different. The bad feeling that's been there for the majority of this year still seems to be below the surface. But the confidence in the economy is there.
Well, let's talk about the confidence and let's talk about emotion, full stop. You tune into some other channels, I hope you don't, and they'll be going crazy about 20,000 points on a certain benchmark at the moment. Is that emotion important?
In the short term, it is, okay? But the fact is crossing through 20,000 isn't likely to bring that surge of money because when we look at our data, in fact, the asset allocation that the Fed has engineered by keeping rates low for the last 8 years has caused equity exposure to move to its highs and money market exposure yielding zero to move to its lows.
So a little bit earlier, we had Carl Riccadonna of Bloomberg Intelligence on, and he talked about FOMO on the boardroom, the fear of missing out, the idea that your competitor's going to go and do something and invest and take market share from you, so you should do the same. The fear of missing the upside in markets, how pervasive is that right now? You've got your 2,300 target, you're looking, Mr. Golub, up at 2,500. This fear of missing out, is it becoming a little bit more dominant?
The option market is sending a very clear message that fear of missing out is ruling markets at the moment, because out-of-the-money calls are now priced historically expensive relative to at-the-money calls. So, you know, if we're moving to 2,400, 2,500, which a surge of emotion could get us to in the first quarter, people really are, they actually fear it rather than, you know, are trading for.
So do you go into neutral, or is it an opportunity to go short?
What it is an opportunity to look at the sectors that are likely to work in a sideways tape.
Walk us through it.
So basically, we found that if you look at the past 20 years or so, there is a pronounced effect for the prior year's losers to outperform in the first months of the new year. And what's interesting about this particular cycle is that post the election, areas like healthcare and technology have really been left behind more than usual, given this sort of surge of confidence in infrastructure and so on that's carried industrials and energy and financials to new highs. And we think those sectors are likely to really be bought once tax loss selling is over.
That was UBS's head of U.S. equity and derivative strategy, Julian Emanuel, speaking on Daybreak last week.
Well, up next, Japan's Toshiba plunges the most on record as the U.S. nuclear renaissance turns into a potential financial nightmare for that company. This is Bloomberg. What'd you miss? The once heralded U.S. nuclear renaissance has turned into a nightmare for the Japanese company Toshiba. Those shares plummeted in Japanese trading, the most since 1974, after Toshiba said it may have to write down billions related to an acquisition made by its U.S. unit, Westinghouse Electric. For more, I want to bring in Bloomberg intelligence analyst Kit Connelly, who covers utilities. So what exactly went wrong here with this investment?
Well, a year ago, Toshiba bought, through its Westinghouse, the U.S. unit, they bought a company called CG&I.
Chicago Bridge and Iron.
Right. It was a subsidiary of them. Everybody's got layers here. But they had the contract to build the nuclear plants for Southern Company and SCANA. So those are the 4 reactors under construction in the U.S. Apparently, in the year since, Toshiba's gone through and realized that their exposure here, their costs are going to be much higher than they had previously anticipated. So they're talking into the billions of U.S. dollars as their possible hit from what they owe under the contract to Southern Company and SCANA.
Well, it's a massive hit for a company. It seems like a massive oversight. Why? What exactly was their thinking in getting into nuclear at this point when I think that's been pretty well chronicled that the energy source is, it's struggling, obviously, as a source of energy, nuclear?
Well, that's mainly in the U.S. If you look in Asia, China is building nuclear plants. India is talking about building nuclear plants. So clearly Toshiba has the idea that there is potential growth out there, and with the size of these contracts, you only need a few of them to make it a significant play. On the other hand, when you have very big contracts like that, when something goes wrong, that's a big problem. Obviously, they thought that they would make this acquisition, get into the U.S. nuclear construction business. Maybe in a few years things would look different and there'd be more business. As it turns out, they're looking at just much higher costs and much more extensive problems, apparently, than they had ever thought.
How does the regulatory environment in the U.S. look different with the change in administration?
I think the general sense is that the Trump administration would support existing nuclear plants. I'm not clear that they've done a whole lot with regard to whether we want to build more of them. And given that the demand for electricity is quite flat in the U.S., frankly, whether we need a whole lot more of any kind of plants for now is in question. But certainly to keep the existing nuclear plants in operation, which was less certain, I think, under the prior administration.
Some that may have been sunsetted may go on for a while.
I think there's an idea, I don't think it's been specified, but that some of the programs like New York State and Illinois have put into place so far, where they subsidize nuclear power the way, for example, renewable power, solar and wind, has been subsidized.
Go ahead. I was just going to say, but will this situation with Toshiba give pause to any future plans? I mean, why did they misestimate the cost? What was so much more expensive than they had estimated?
Apparently, the payroll costs were higher than I'm not sure what they were looking at before. Payroll was one area, and apparently there was just a lot more material that they needed to acquire. And they haven't been specific enough, I think, to really understand, because obviously it does seem they only paid $200 and some million for the whole company, and now they have an exposure of maybe 10 times that. So it's a bad miss, obviously. And to answer your other question, I think they really have raised a question that has to be in everybody's mind, whether in the U.S., Europe, et cetera. With this kind of uncertainty, who would want to go into building a nuclear plant when you can build a gas plant these days for a tenth of the capital cost?
Interesting. All right, Kate Conolidge, thank you so much for giving us some perspective on this Toshiba situation. He's with Bloomberg Intelligence.
It's time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Facebook's Oculus has acquired startup The iTribe, a company that tracks eye movement in virtual reality. Terms of the deal, reported by TechCrunch, weren't disclosed. Facebook aims to take the lead in social interactions in VR. Following eye movements makes it easier to understand people's expression and lets them communicate effectively in a virtual world. U.S. banks will no longer be able to deal or invest in physical forms of industrial metals after April 1st. The Office of the Comptroller of the Currency issued the new rules today. The decision comes after lawmakers accused Wall Street banks of seizing unfair advantages in metals and energy markets in recent years. And U.S. fast food giant Yum brand says it plans to refranchise its KFC restaurants in Turkey and add 400 locations in the country in the next 5 years. It's part of the global shift away from owning its own outlets. The company, which also owns Pizza Hut and Taco Bell, says 98% of its restaurants around the world will be owned by franchisees by 2018. And that's your Bloomberg Business Flash.
Coming up, what you need to know to gear up for tomorrow's trading day. That's up next. This is Bloomberg.
Don't miss this. U.S. weekly crude oil inventories. Those numbers coming out at 10:30 Eastern tomorrow.
That's all for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.
Hey, I'm Ty Pennington.
I'm Taylor Riggs, and you're watching Bloomberg Technology. Let's start with a check of your first word news. In his last speech as U.S. Secretary of State, John Kerry today criticized Israel's settlements policy.